Imagine standing at a mechanic's counter. Your car is fixed, but the shop won't hand over the keys until you cough up $1,000. That massive, unexpected bill usually happens because most drivers simply accept whatever default deductible the insurance company pre-selected when they signed up for their policy. When you don't choose that number intentionally, you're setting yourself up for one of two painful scenarios. Either you bleed cash every month through unnecessarily high premiums, or you risk a massive out-of-pocket hit during an emergency. This diagram shows the core trade-off you're making. You have two levers: your monthly premium drag and your out-of-pocket hit. Pulling one up automatically pushes the other down. This deductible amount functions as a mandatory financial trade-off, where you exchange guaranteed monthly cash flow for emergency risk. To make the right trade, you need to know exactly when that bill comes due. Your deductible only comes into play when you file a claim under your own collision or comprehensive coverage. When that happens, you have to pay your exact chosen dollar amount first. The insurance company will not send a single dime to the repair shop until your portion is covered. And here is where it catches people off guard. That required out-of-pocket dollar amount resets for every single separate claim you file. If you're used to health insurance, you might expect an annual out-of-pocket cap where your insurance eventually covers everything. Auto policies don't have that. If you file 3 claims, you pay that deductible 3 separate times. The rules change if someone else is responsible. If another driver causes a crash, their liability coverage pays for your repairs, bypassing your deductible entirely. Because deductibles only apply to damage on your own vehicle, the specific number you choose strictly dictates your personal emergency exposure. Raising your deductible from $250 to $1,000 will significantly reduce your monthly insurance bill. Depending on your specific insurer, making that shift can cut the collision portion of your premium by 15 to 30%. But that discount comes with a catch. By lowering your monthly bill, you are instantly taking on an additional $750 of out-of-pocket financial risk per accident. This chart visualizes the break-even math. The top line is your $750 risk. The upward line is your accumulating $40 monthly savings. It takes exactly 19 months to cover that risk gap. After that, the lower premium turns into pure profit. Taking on that higher risk captures extra cash every month, but the math only works if you can sustain a multi-year clean driving record. We also must examine the underlying value of the asset you're insuring. Let's use a depreciated car worth $5,000 as our baseline. This graphic illustrates the terrible math of paying a $1,200 premium with a $500 deductible to protect a $5,000 asset. You're sacrificing nearly 25% of the car's value every year just for the right to repair it. This brings us to the 10x rule. This standard financial threshold dictates dropping comprehensive and collision coverage entirely if your vehicle is worth less than 10 times your annual premium cost. Instead of paying the insurance company, redirect the money saved by dropping that extra coverage into a dedicated savings account to eventually replace the vehicle. For older vehicles, self-insuring by dropping that extra coverage is mathematically superior to carrying a low deductible. Now consider a common, frustrating scenario. You back into a pole, causing exactly $600 in cosmetic damage, and you currently carry a $500 deductible on your auto policy. If you file a claim for this, you have to pay your $500 first. That means you net a meager $100 payout from the insurance company. The hidden penalty comes later. Insurance companies will almost certainly raise your monthly premium at renewal because you now have a claim history. That short-term gain is erased by a long-term bleed. The resulting premium spike will vastly exceed that $100 payout over the subsequent year. The best defensive rule is that minor repairs should be paid entirely out of pocket to protect your long-term rate stability. This trap renders a low deductible largely useless for small scrapes. Filing the claim mathematically hurts you more than it helps. This chart maps out a step-by-step decision matrix to pinpoint your optimal deductible. The very first question is, do you have $1,000 or more in liquid emergency savings? Without those savings, reaching for a high deductible just to lower your monthly bill is a mistake. If you can't pay the mechanic, you lose your transportation. Stick to a $250 or $500 deductible. With emergency savings, you advance to the asset value check. Is your car worth 10 times your premium? Failing this means dropping coverage entirely. Passing moves you to the final test, a clean driving record for 3 years. In a high-risk urban area or with recent accidents, a $500 deductible limits your exposure to probable claims. But with a clean record, a $1,000 deductible minimizes the drag on your monthly budget. The correct deductible is never universal. It is entirely dictated by the exact size of your liquid emergency fund and your local risk factors. Your next step is to contact your insurer and request side-by-side premium quotes at the $250, $500, and $1,000 levels. Run those exact quotes through the 19-month break-even math we covered earlier to see if adjusting your policy is profitable. Resist the common mistake of treating your insurance policy as something you set once and forget. Your financial situation from 5 years ago rarely matches your current savings reality. Treat your deductible as an annual assessment. As your emergency funds steadily grow, actively raise your deductible to capture those premium savings. It all comes down to the golden rule of auto insurance. Never set a deductible higher than the exact amount of cash you can afford to lose tomorrow without going into debt.